Imagine, you go to a store in the morning, a loaf of bread costs $50, you think, expensive, but fine. In the evening of the same day, you come back. The same loaf already costs $200. The next day, $800. A week later, $10,000. Your salary of $5,000 per month now covers one single grocery trip. Welcome to hyperinflation, a nightmare that destroyed the Weimar Republic, Zimbabwe, and Venezuela, and one that could come to America. Today we will examine what hyperinflation looks like in practice, what warning signs already exist in the United States, and why it could happen faster than you think. Hyperinflation is not ordinary inflation. Ordinary inflation is when prices rise by 2 to 5% per year. Moderate inflation is 10 to 20%. Hyperinflation is when prices rise by 50% per month or more. On an annual basis, that is thousands, millions, even trillions of percent. Economists define the threshold of hyperinflation as a 50% increase in prices in 1 month. If in January a loaf of bread costs $3, in February $4.50, and in March $6.75, that is hyperinflation. But numbers do not convey the horror. Let us look at real examples. After the First World War, Germany was crushed by reparations, payments to the victors totaling $33 billion at 1920s prices. The government could not collect such taxes. The solution was to print money. The central bank, the Reichsbank, ran the printing presses at full speed. The amount of marks in circulation exploded from 81 billion in 1920 to 496 quintillion marks in 1923. In 1918, one loaf of bread cost 0.63 marks. By 1923, it cost 201 billion marks, one loaf of bread. People transported money in wheelbarrows and baskets, not because they were rich, but because mountains of banknotes were required to buy milk. A famous story tells of a woman who left a basket full of money on the street for 1 minute. When she returned, the money had been thrown on the ground and the basket was stolen. The basket was worth more than the billions of marks inside. Workers were paid twice a day, in the morning and at lunchtime, because by evening the money lost half its value. Wives waited at factory gates with bags to run to stores immediately after payday. Restaurants did not print menus. Prices changed every hour. Waiters announced prices verbally. People burned money in stoves. It was cheaper than buying firewood. Children built pyramids out of bundles of banknotes. Toys were more expensive than paper money. By November of 1923, one United States dollar was worth 4.2 trillion marks. The consequences were devastating. The middle class was destroyed. Savings evaporated. Pensioners died of hunger. Social chaos, crime, despair. And it was precisely this chaos that brought Adolf Hitler to power 10 years later. Hyperinflation is not just an economic phenomenon. It is a catalyst for political catastrophe. In Zimbabwe, between 2007 and 2009, President Robert Mugabe confiscated farms from white farmers and handed the land to supporters with no experience. Food production collapsed by 60%. The government began printing money to cover the budget deficit. Peak inflation reached 89.7 sextillion% per month in November 2008. Prices doubled every 24.7 hours. What cost $1 in the morning cost $4 by the evening of the next day. Zimbabwe printed a banknote with a face value of 100 trillion Zimbabwean dollars. With it, you could buy a few eggs, maybe. Salaries were paid daily in bags of cash. People spent them within an hour, otherwise the money became worthless. Stores closed. Sellers did not know what price to set. Goods disappeared from shelves. Farmers and producers refused to sell for useless money. Barter became normal. Doctors treated patients for chickens. Teachers were paid in sacks of corn. Unemployment reached 94%. Average life expectancy fell from 60 years to 34 years. People died of hunger in a country that had once been the breadbasket of Africa. In 2009, the government abandoned its own currency. Zimbabwe began using the United States dollar and other foreign currencies. They officially admitted, our money is worthless. In Venezuela, from 2016 to the present, the country possessed the largest oil reserves in the world. But the socialist governments of Chavez and Maduro nationalized companies, distributed money to the population, and printed currency to cover deficits. When oil prices collapsed in 2014, the economy imploded. Peak inflation reached 1.7 million% per year in 2018. By 2021, cumulative inflation reached 5.5 billion% over several years. In 2018, a cup of coffee cost 2.5 million believers. 1 kilogram of meat cost 9.5 million believers. The average salary was 5 million believers per month, enough for 2 cups of coffee. Venezuela printed a banknote worth 1 million believers. Its value was about 50 cents. People weighed money instead of counting it. A stack of banknotes weighed more than the goods it could buy. Cash machines limited withdrawals to laughable amounts, the equivalent of 5 to 10 cents, because banks physically could not load machines with enough banknotes. 3 million Venezuelans, about 10% of the population, left the country, the largest refugee exodus in the history of Latin America. The average Venezuelan lost 11 kilograms of body weight due to hunger. This became known as the Maduro diet. People rummaged through garbage bins. Zoos lost animals. Starving crowds broke in and ate horses, flamingos, even lions. Hospitals closed. No medicines, no equipment. Infant mortality jumped by 30%. And this is happening right now. Venezuela is not ancient history. This is the 2020s. The common pattern of all hyperinflations is the same. The government prints money to cover deficits from wars, social programs, or corruption. Trust in the currency collapses. People realize money is losing value. The velocity of money explodes. Everyone spends immediately. No one saves. Production stops. Why sell goods for worthless money? Social collapse follows. Hunger, violence, mass migration. And the key point is this. It happens fast. Weimar took 2 years. Zimbabwe took 2 years. Venezuela took 3 to 4 years from start to peak. When hyperinflation begins, stopping it is almost impossible. It is the economic equivalent of a nuclear reaction. But this cannot happen in America, you will say. The dollar is the world's reserve currency. The United States is not Zimbabwe. Really? Let us look at the numbers. Money printing. Unprecedented scale. The M2 money supply, meaning cash plus deposits plus savings in the United States. 2008, $8 trillion. 2020, before COVID, $15.5 trillion. 2023, $21 trillion. In 3 years, from 2020 to 2023, the Federal Reserve printed $5.5 trillion, more than during the previous 100 years of the Federal Reserve's existence. 40% of all dollars that have ever existed were printed since 2020. This is not a conspiracy theory. These are the Federal Reserve's own data. Look at the M2 chart on the Federal Reserve Economic Data website. A vertical line upward in 2020 and 2021. Government debt, out of control. United States government debt. 2000, $5.7 trillion. 2008, $10 trillion. 2020, $27 trillion. 2025, $36 trillion. Debt is growing by $1 trillion every 100 days. Not a year, 100 days. The debt to gross domestic product ratio is 123%. This is the level after which, historically, debt crises begin. For comparison, Japan, 264% stagnation for 30 years. Greece, before the crisis of 2010, 146% economic collapse. The United States is approaching the danger zone. Interest payments, the fastest growing budget item. Interest payments on government debt. 2020, $345 billion. 2023, $659 billion. Line C's, 2024 to 2025 forecast, more than $1 trillion. This is more than the entire defense budget, $850 billion. The United States spends more on interest payments than on the military, and this is with an average rate of 3 to 4%. If rates rise to 6 to 7%, the level of the 1990s, interest payments will explode to $2 to $3 trillion per year. That is 40 to 50% of all tax revenues just to pay interest. The mathematics becomes impossible. Budget deficit, structural and growing annual United States budget deficit. 2019, $984 billion. On task to 2020, $3.1 trillion. COVID, 2023, $1.7 trillion. 2024 to 2025 forecast, more than $2 trillion. The United States spends $2 trillion more than it collects in taxes every year. Where does this money come from? The government issues bonds. The Federal Reserve buys them, creating money out of thin air. This is debt monetization, the technical term for printing money to cover the deficit. This is exactly how Weimar, Zimbabwe, and Venezuela began. Inflation, official versus real official inflation, consumer price index, 2020, 1.4%, 2021, 7%, 2022, 9.1%, a 40-year peak, 2023 to 2024, 3 to 4%. The Federal Reserve celebrates, we defeated inflation, it fell to 3%. But there's a problem. The consumer price index does not reflect reality. Why official inflation is understated? 1. Product substitution. If beef becomes more expensive, the government assumes you will switch to chicken. The basket price falls in calculations, but you are simply eating worse. 2. Hedonic adjustment. If a new iPhone is more expensive but has a better camera, the government claims you received more value, so inflation is lower. But you paid more. 3. Housing exclusion. Rent and home prices are rising by 20 to 30% per year in major cities. But in the Consumer Price Index, housing is counted through owner's equivalent rent, a fictitious calculation that understates reality. Real inflation, using 1980s methodology. The Shadowstats website, which calculates inflation using the old methodology, shows that real inflation in 2022 and 2023 was 15 to 17%, not 9%. How people feel it. Gasoline, from $2.50 in 2020 to $4 to $5 in 2022 and 2023. Eggs, from $1.50 to $6 to $8 per dozen. And bread, from $2 to $4 to $5. Rent, plus 20 to 40% in most cities. Insurance, car, and health, plus 30 to 50%. Prices for essential goods rose by 50 to 100% in 3 to 4 years. But the government says inflation is 3%. Velocity of money, a critical indicator. Velocity of money shows how quickly money changes hands. High velocity means people spend quickly, fearing money will lose value, a sign of approaching hyperinflation. Low velocity means people save and trust the currency. From 2008 to 2020, velocity fell. People saved after the financial crisis. But since 2020, velocity has begun to rise. People spend faster. Savings are shrinking. The savings rate fell from 33% at the COVID peak to 3 to 4% in 2023 and 2024, below pre-crisis levels. This is an early sign. People feel that money is losing value. Loss of trust in the dollar. Global, the United States dollar has been the world's reserve currency since 1944, Bretton Woods. But this is changing. De-dollarization is gaining momentum. China and Russia trade oil and gas in yuan and rubles, bypassing the dollar. Saudi Arabia is discussing selling oil to China in yuan. BRICS, Brazil, Russia, India, China, South Africa, plus new members, are creating an alternative trade currency. Central banks are selling United States Treasury bonds. China and Japan have reduced holdings by hundreds of billions. The dollar's share of global reserves, 2000, 71%, 2020, 59%, 2024, 58%. The decline is slow, but the trend is obvious. When the world stops trusting the dollar, demand falls. If demand falls while supply rises, due to money printing, the price collapses. Political dysfunction, inability to solve the problem. Washington is deadlocked. Democrats want more social spending. Republicans want tax cuts. No one wants to reduce the deficit. The debt ceiling is a political circus every year. In 2023, the United States was on the verge of a technical default. Congress raised the ceiling at the last moment. But this is a temporary fix. The Fitch rating agency downgraded the United States from AAA to AA+ in 2023. The reason was deterioration of fiscal position and political dysfunction. This was the second downgrade after Standard & Poor's in 2011. When rating agencies lose faith in the United States, it is an alarm bell. Historical parallels? Chilling? The difference is that the dollar is still the world's reserve currency. This gives the United States time. But this advantage is not eternal. Hyperinflation does not begin gradually. There's a trigger moment when trust in the currency breaks. Possible triggers: debt crisis. The United States cannot raise the debt ceiling. A technical default, global markets, panic. The Federal Reserve prints trillions. The dollar collapses. Loss of reserve, currency. Status: Saudi Arabia sells oil only for yuan, OPEC follows. The petrodollar is dead. Trillions of dollars return to the United States. An inflationary wave, geopolitical shock war with China over Taiwan. China sells $850 billion of bonds at once. Interest rates jump to 15 to 20%. The Federal Reserve prints hyperinflation, internal crisis, mass unrest, political collapse. The government prints money to distribute to the population. Trust breaks phase 1, beginning months 1 to 3. The trigger happens. The dollar falls by 30 to 40% against other currencies in a few weeks. The United States imports 40% of consumer goods. Prices for electronics, clothing, and food jump by 50 to 100%. Gasoline from $4 to $10 per gallon. This affects transport, delivery, and production. The Federal Reserve raises interest rates to 10 to 15% to defend the dollar, but this kills the economy. A recession begins, unemployment from 4% to 15%. People panic. Bank runs begin. Everyone wants to withdraw money and buy real assets. The government announces capital controls limits on cash withdrawals, $500 per day, a ban on taking money out of the country. Phase 2, acceleration months, 4 to 12. Inflation accelerates, 5% per month, then 10%, then 20%. Stores, prices change daily. Electronic price tags update every morning. Products disappear from shelves. Producers do not want to sell for rapidly depreciating dollars. Wages, employers pay weekly, then twice a week. People demand payment in gold, Bitcoin, or indexation to real inflation. Real estate. A house for $500,000 becomes $5 million in a year. But this is not real growth, just dollar devaluation. Stocks. The S&P 500 from 5,000 to 50,000 in nominal dollars. But in real money, gold euros, it falls by 70 to 80%. Savings. If you have $100,000 in an account, after 1 year, it buys what $10,000 used to buy. Pensioners are destroyed. Barter and alternative currencies. People refuse dollars. Trade shifts to gold and silver coins. Bars, cryptocurrencies, Bitcoin stablecoins, foreign currencies, euro, Swiss franc goods, gasoline food tools, social breakdown, crime explodes, store looting attacks on trucks. The government introduces curfews, martial law in major cities. The middle class disappears. Those who had savings in dollars are now poor. Only those with real assets, land, businesses, gold stay afloat. Migration begins. Americans flee to Canada, Europe, Latin America. For the first time in history, a mass exodus from the United States. Phase 3 peak and collapse. Years 2 to 3, hyperinflation reaches the peak. 100% per month or more, prices double every few weeks. The United States prints banknotes of $10,000, $100,000, then $1 million. But even this does not keep up with inflation. The state loses control. Taxes are not collected by the time money reaches the Treasury. It has lost value. The government cannot pay the military police. Desertion, corruption flourish. Some states declare independence or introduce their own currencies. Texas, California may separate. Do the United States fall apart? The end of hyperinflation. New currency. The government introduces a new dollar backed by gold. Exchange 1 million old equals 1 new dollar. Dollarization. The United States begin using the euro, the yuan, or another currency. The dollar dies. Digital currency, CBDC. The government introduces a digital dollar with programmable control. Hyperinflation stops, but freedom dies. Long-term consequences. Even after hyperinflation ends, the damage is enormous. Gross domestic product falls by 50 to 70%. Unemployment 30 to 50%. The middle class destroyed, trust in government zero. Political instability, possible dictatorship, or civil war. The United States are no longer a superpower. China dominates. The world moves to a new reserve currency. How to protect yourself. Practical steps. 1. Get rid of dollar assets. Do not hold cash except for short-term needs. Do not hold bonds. They will be completely devalued. Bank deposits minimal. 2. Invest in real assets. Gold, silver physical metal, not exchange, traded funds. Real estate, preferably without a mortgage. Shares of real companies, producers of goods, food, energy materials, cryptocurrencies, Bitcoin, Ethereum, your own wallet, not exchanges, 3 foreign currencies, Swiss franc, Singapore dollar, accounts in foreign banks, if legal. 4 skills and goods, learn useful skills, repair medicine, agriculture, stock food for 3 to 6 months, tools, seeds, medicines, goods for barter. 5, flexibility and evacuation plan, second passport if possible. Evacuation plan where you will go if the United States become unlivable. Are these measures realistic? For most people, difficult. But even partial preparation is better than nothing. Probability of hyperinflation in the United States, an honest assessment. The next 5 years, 10 to 20% probability, unlikely, but not impossible. The next 10 to 20 years, 30 to 50% probability. If the trajectory of debt and money printing does not change, it becomes likely. The United States has advantages. Reserve currency, powerful economy that buy time, but time is running out. History shows countries that print money without limits always pay the price. Always. The question is not can it, but when, and will you be ready?